Michael, welcome. Nice to see you. Nice to be back in that beautiful room of yours. Love it. Talk to us about the markets and whether you think now is the time to start nibbling at some of the growthier names, the tech names, or whether it's still time to play it safer.
Sure. Yeah, I think this year the mantra of the market is it's going to be going nowhere fast. So it's really a year about positioning. When the S&P is up 20-30%, positioning is less relevant. When the market's down a little bit or flattish on the year, it's all about positioning. And so as the world continues to slow, and I don't think there's much of a debate about that, the question is how long are we going to slow for and what's priced in? And we think the answer for the first question is we're going to be slowing into the middle of next year, and we have not priced in very much yet. Investors should continue positioning or repositioning their portfolio to stocks that act as counter-cyclicals that are less cyclical to the economy. You've got two trades going on right now: the higher rates, higher inflation trade, which is likely to end sooner than later, and then the growth slowdown trade, which has got at least another year left. So we would continue to avoid high beta stocks and expect cyclical stock leadership to continue to narrow increasingly as this slowdown continues.
So as I look at your list of sells, they are, I would call them concentrated in cyclical areas like DuPont, Fluor, Textron, HP, Hillenbrand, right?
Yeah, there's a couple of different ways to pick buys and sells. We do both fundamental approaches and macro approaches. This is a real pure macro approach. What we did is look at which stocks in the S&P 500 or 1500 have the highest correlation to earnings revisions. And these 5 stocks have correlations of earnings to earnings revisions in the high 80s. So given our view that earnings revisions are headed lower and lower and lower over the foreseeable future, you don't want to be having too many stocks in your portfolio that have performance profiles that only do well when revisions are moving higher. And conversely, what we think investors should increasingly embrace are stocks that can do well in an earnings slowdown. So that's names like Campbell Soup, AT&T, Eastern Government Properties, Cable One, Kimberly-Clark Corp. There are many more stocks in that list, but these are stocks that have a negative correlation of about 85% to earnings revisions. So earnings revisions go down, these stocks are likely to outperform. So it's a pure macro view on stock selection. Of course, adding a fundamental overlay would make sense as well.
Michael, it's Kelly, and I'm in a cyclical mood today. So I want to ask you a couple of questions for those of us who might be feeling this way. I look at commodity prices breaking out, right? I look at rates moving higher. I look at stocks moving higher. I look at growth holding in there. All of these factors, the steepening yield curve, we're up, 40 or 50 basis points in just a couple of weeks on 2s10s. And I just think, what if there is still some cyclical momentum here?
Well, I think there is some cyclical momentum, but it's going to be increasingly narrow. We're even beginning to see stocks that typically perform well when rates go up, like banks, not performing very well. So while the market's up today and there is a cyclical tilt to leadership today, again, we look at the market since the beginning of the year, we've gone nowhere. And I don't think we're going really anywhere for the rest of the year. And so I think we're going to see a lot of volatility, a lot of gyration in stocks. And where we have the most highest conviction is thinking about what's the end result of all of this increase in rates, inflation, gasoline, literally everything. We've had a shock to literally everything that helps to explain a slowdown. And we're going to get a growth slowdown from that. And that's how you want to be thinking as opposed to reacting to, let's say, Bullard today.